Here's what's interesting about silver. So obviously it had a parabolic run, coming off a little bit was not expected, but the way it did so.
I mean, folks were saying it was trading like a meme stock.
It was, and the way it was trading, especially at the very end of the month, you had this, this kind of hammering of trades during the illiquid market hours. It really looked a lot like there was manipulation going on under the hood. We know that there were some big players out there that had short positions. The comics I think had 300 to 1 in terms of paper to physical delivery. When you look at the physical market, most of the sell-off happened in the paper futures market. Shanghai physical, barely traded down at all. And so this really had echoes to past, manipulation within the silver market we had, in the 2015 era. So I think that represented a buying opportunity for investors, and I think we've seen that. Investors are looking at this and saying, all right, the very fact that this traded down the way it did, in what looks to be a manufactured fashion, is supportive of the longer-term narrative to own it. What you're seeing now with gold and silver, kind of a new AI premium built in. So it's not only just store of value. Silver, of course, has its industrial use case, but now there's this kind of AI premium on top, which brings with it volatility. So we're telling investors, listen, this is going to have probably more volatility than you're used to. Although if you look back 10 years, gold and silver have had volatility. But the important thing to remember is that the structural tailwinds are in place. You've still got all the big buyers, e.g. the central banks across the world. You've got even now, India starting to, recognize silver as collateral. So it's, there's this continuing move away from the dollar into gold and silver, and that's not going to slow down anytime soon.
And Ben, in terms of where gold prices head from here, so all right, so Polymarket looks like they have odds that gold prices will be at 4,600 by the end of the month. Then Bloomberg has a note from Jefferies. I'll read this one to you because it's interesting. They raised their 2026 price forecast, Ben. They go to 5,000. They were at 4,200, saying we continue to see two main supportive macro factors for gold. Here's what they said. Inflation and dollar debasement, they say. Investors and central banks concerned about these factors have only really one option, hard assets. What do you make of that?
That's exactly it. I mean, that is the freight train that's not going to slow down anytime soon. So, everything else is kind of ancillary, even the kind of AI premium, but this is part of the debasement trade. And again, I mean, dollar debasement happens over decades. This isn't quarters at a time. And so we're much closer to the ending the year at 5,000 per ounce in gold, because again, it's just, we see central banks voting with their dollars. They're selling treasuries, they're buying gold, and that's just not going to slow down anytime soon.
Did the Warsh nomination, by the way, you saw that, did that sort of impact long-term gold expectations for you?
That was interesting because the market obviously responded to that, very hawkishly. Right. And he was kind of famously anti-QE in 2010, but I told an investor, I said, listen, back in 2010, it was easy to be anti-QE because, America hadn't maxed out its credit card yet. Now you have to find a way to, keep rates, kind of firm. I mean, we just can't afford the debt. He kind of floated the idea of yield curve control, which I think is interesting. He's also very notably vocal about AI being deflationary, which I agree with. I mean, we're seeing it happen real time with kind of agentic capabilities disrupting software. That's going to be very disruptive, but very deflationary long term, which of course could lead to decreasing rates. So I think the market's kind of coming back away from that overly hawkish narrative a little bit.
When talking about gold with clients, do you tell them, Ben, I like the metal and the miners?
Yeah, absolutely.
You do?
Yeah, absolutely. Because the miners, you've got two things. First of all, a lot of gold miners also mine other things. So when you look at, what's interesting about the AI trade, so to speak, is that it's starting to bump up into the physical world. So silver, copper, eventually uranium, rare earths. The miners have exposure to all that. So we're telling clients it's not just gold and silver, it's the miners, gold, silver miners, as well as miners more broadly.
This silver trade, I think, is fascinating.
Oh, I do as well. And I've been all over it for a couple of years and even got out of like 30% of it in the month before the crash. And I missed some of the upside as well. But the fundamental story for either of those two metals has not changed at all. Silver's electrification, scarcity, gold is central bank buying. Both of those stories are still intact. But what has changed is the price. And when we got up to those lofty levels, so many people had gotten in late. And then one little thing changes and everybody heads to the exits at the same time. That's what we saw. Now, just because I can identify it as a market positioning correction, I don't think that necessarily means it has to be over. I think the trade is relatively volatile. I think long term, I'm fine with being long gold and silver, which I am, and copper, by the way. Oh, okay. But I think that that when market positioning gets so stretched, it could shake a little bit.
Obviously gold's up 65%, and now we're pushing up past $4,500. And it's its best year since 1979, but silver has really stolen the show. That's up 147%. And I think what's remarkable about this rally isn't just the quantum or the magnitude, it's really the quality of the demand that's supporting it. It's also interesting that they've rallied for quite different reasons. So gold is all about central banks. And according to the World Gold Council, since 2022, the central banks have purchased roughly over 1,000 tonnes of gold annually. And that's roughly double the historic average. And more importantly, they still indicate that they continue to plan purchasing it. For silver, that's really a supply story. We're in the 5th straight year of deficits. We're consuming something like about 200 million ounces a year more than we produce annually. So if you add China's export restrictions, which really just kicked in on January the 1st, you've really got a proper, genuine supply squeeze that's meeting accelerating industrial demand.
So what does that mean for Hecla? Can you invest more to produce more? We keep hearing about deregulations in the mining space, for example. Does all of this pave the way for you to do that?
I think it's very helpful. Certainly permitting timelines have expanded significantly, but a lot of silver is produced as a byproduct, so a byproduct of gold mining, of lead and zinc. And there's very few primary silver deposits, and any new discovery or development project takes many, many years. And so the fact that we're already in production really helps us.
Would you look outside of North America to expand your assets and your capacity?
That's an important question, because I think one of our brands is that all of our assets are in Canada and the US, as you noted in your introduction. We're the largest producer in the Canada and the US. And what that does is it gives investors certainty. There's, we're in operating jurisdictions that have much more certainty, no risk. We're not going to wake up and read that our mines have been taken away from us or there's some new surprise tax. It's predictability and certainty, and that should give our investors a lot of comfort.
We have energy companies meeting with the president right now down in Washington. The other thing Venezuela has is significant critical mineral deposits, and it has some precious metals deposits as well. I think about gold, for example, gets a lot of attention. Would you look at an opportunity like that if the right security, the right guarantees, the right contracting was put in place?
I think security is the most important thing, and that remains to be determined. More importantly, Venezuela has very large gold deposits. I'm familiar with them. Silver deposits, there are some, but really right now our appetite for risk is reasonably low. It's very dynamic. We want to see things settle down a little bit and understand exactly the implications of investing in a country like Venezuela. And we would consider it so long as we became comfortable with the risks.
Okay. And finally, your take on M&A, whether it's for Hecla specifically or across the industry, especially as we've seen a week where reports have started percolating again about the possibility of a combination of Rio Tinto and Glencore.
Yeah, I can't really comment on that, but obviously consolidation in the silver space has obviously happened, and that's really driven by the scarcity of primary silver deposits. So we see that happening. The best thing that we can do is really continue to improve our own business, focus on maintaining costs, operational efficiencies, all the things that are within our control.
And finally, silver, can it keep going higher, given what you've talked about with supply-demand dynamics?
I think absolutely it can. The drivers are industrial, and then you've got the tailwinds for the gold price going up. So historically, there's been a correlation between gold and silver. It's been roughly 60-1. Towards the end of a bull run cycle, silver experiences explosive growth. And I think the fundamentals for gold are very, very robust, and therefore silver as well. But underpinning silver is the industrial demand, which is really quite significant.
8 months ago, over 150% gain on silver, blowing everything else out of the water. The only thing I'm watching here is just in the last day or so, we've now hit this level. And look at this trend line. This trend line, you guys know I'm big on these longer term trend lines. And listen, it doesn't mean price has to stop here, but I think we can all agree that in reality, logic would dictate some sort of retrace here. But if there's the bear market low of 1982 here, if we take that low and connect it to the bull market high of 2011, we literally just tagged that trend line here at $72 to $73. Now, again, it could continue, but as a technician, I need to monitor this line over the next week or two to see if it turns out to have teeth. Does it cause some sort of corrective move? And the only other thing I would say is I do believe we've seen a lot of momentum from Bitcoin going into silver. Even investors, it's almost like become the meme stock is being in silver now. And we know that when these things have corrections, they can be sudden and quick. As much as I love silver long term, don't be surprised if you have a very quick 1 or 2 week correction of 20% in silver and then look to buy that retrace.
Okay, so you would maybe see a small pullback on what? Because the fundamentals, I mean, this has been the argument that you've got so many positive factors driving silver. Obviously, huge industrial demand as for everything from the electrification process to AI to solar. We've got this whole idea that the physical silver isn't there in the exchanges, that we've got more paper silver than physical silver, and that those shorts are starting to show, or that the demand is starting to expose that lack of physical silver. We've got the debasement idea. We've got the silver as a monetary asset as well, as a hedge to the, as we discussed before, lack of faith in fiat. There are this perfect storm of forces for silver. Even a lot of people are saying military industrial use, that there's just a lot of war drums rattling on the horizon for 2026, 2027, and silver is used very heavily in defense. So that there's just so many factors driving silver higher. Why would we see a pullback?
Yeah, and so that's a great question. And I think what we have to understand is silver is a very momentum-driven asset, right? When things are bad, things are bad. And when we see like the 2011 run, it was just epic to the upside. And one more thing I'll show you on this chart, and this is you're right about all these other factors, right? They're very bullish, although those narratives can switch very quickly. But if we look at the move here that we saw in 2011, it was about 500%. And we are now at that same approximate extension move from the April, or I should say from the March 2020 lows. We're at about 515%. And so what we know about silver is that, again, they call it the poor man's gold. People rush into it for the momentum trade. And while I love every point you made on a macro longer term scale, and it has me bullish for silver over the next 5 years, in the near term, I do think that we are now overdone on silver, and silver needs a flush out of the weak hands that have been jumping on this like a meme stock. You and I both know that the meme stock crowd that's just buying it because they think they can dump it for another 50% upside, those are the ones that have to be washed out, clean house, and then silver can get back to fundamentals of grinding higher at a slower pace that will be much, much healthier. But it's not healthy to see silver go this much vertical, and that'll catch people off guard when it corrects massively.
So where do you see silver Q1 of 2026?
So I think we're going to get a pullback to $50. I think you have the former all-time high here from 2011. I think we're going to have a correction back down in the first quarter of 2026, back to $50. I will be waiting there and buying like crazy, but I do think we will get a flush back down. And again, if we talk percentages, what kind of drop from here would that be? We'd be looking at about a 30% pullback in silver. Again, considering it's up 150% from the lows in April, that wouldn't be super outlandish in terms of a retrace.
And that, you say, is weak hands, short-term traders, retail investors just getting out? I mean, is that enough? I mean, it's a small market, relatively speaking, but is that enough to make such a big correction in silver?
It will be. Yeah, it will be. And we can see the momentum. I mean, look at what we've gained just in the past week when most institutions honestly are on vacation, right? I mean, most institutions, they left a week ago and they won't be back until the beginning of the year. And so it really leads the retail crowd to drive the silver market, right? They're buying options on silver. And when they buy, and this is what happened in the meme craze with GameStop, is that they'll buy options. And then because these institutions are filling those orders via options, they have to protect themselves and ultimately buy silver to back that just in case it does go up. And so it creates this almost self-fulfilling prophecy of price going up, up, up until it turns. Once it turns, it corrects massively.
The silver price had been lurking around about the $30 to $35 an ounce band for first half of this year. Gold gave it a little bit of its own buoyancy to start with. But more importantly, is that word again, tariffs.
In April 2025, US President Donald Trump announced a sweeping set of tariffs as part of his Liberation Day.
What we saw after Liberation Day was that the gold price spiked, but silver actually kind of went down a little bit. And if you're looking at the gold-silver ratio, that spiked to above 100. And previously that's been a big signal that silver's likely to outperform gold.
The gold-silver ratio, the price of gold divided by the price of silver, serves as an indicator for investment and market trends. It reflects how many ounces of silver are needed to buy 1 ounce of gold, helping investors gauge when to buy or sell. A low ratio means gold is relatively cheap, while a high ratio indicates silver is undervalued and likely to rise. And in April 2025, the ratio reached a historic high. Gold and platinum were exempt from the tariffs because they were deemed as essential to the US economy. But silver wasn't on the critical minerals list at the time, creating uncertainty about what would happen if it were.
The risk managers in financial and industrial entities did not want to let any metal go out of the States for fear that it might come back in at 35% higher, for example. So they'd been sitting on it, and that was starting to cause a little bit of tightness. And then India kicked in.
India is the world's largest consumer of silver. Every year, it uses about 4,000 metric tons, mostly for jewelry, utensils, and ornaments. Silver is also seen as an affordable investment option in a country where about 55% of the population depends on agriculture for their livelihood.
So we had a good monsoon and a good harvest, which means that farmers are coming back into the market with a fair amount of disposable income. And farmers don't really like the banks very much. So gold and latterly silver tend to be the first port of call when they've got the harvest in.
The monsoon harvest season in India typically ends in late September or early October, and that time frame coincides with India's biggest public holiday, Diwali, a 5-day festival of lights celebrating prosperity and good fortune.
Diwali is the time of year when millions of Indians will buy gold for gifts, but this year we've seen a real rapid pivot into the silver market.
As preparations for the festival were underway, the price of silver in India rose sharply, reaching a record high of 170,415 rupees a kilo, an 85% rise since the start of the year.
Indians make early investments ahead of the wedding season, and the buying of gold and silver is a tradition which is focused around positivity and prosperity. This year, the high prices and lower volumes that we saw in gold meant people rapidly pivoted towards silver, so much so that we saw shortages in Indian silver refineries.
But 80% of India's silver supply is imported. And while the UAE and China are increasingly supporting that demand, the UK is traditionally India's largest supplier. And meeting that demand became a challenge. Since 2022, London's vaults have emptied rapidly. In June that year, the London Bullion Market Association held about 31,000 metric tons of silver. By March 2025, the volume had fallen by around a third, to about 22,000 metric tons, its lowest point in years.
We primarily do gold, or gold coins. You can get hold of them reasonably quickly from the raw mint. But I've asked about silver, and it's at least a 2-week timescale from when you order it. So even the raw mint is being affected.
In October, the squeeze was such that traders had to pay much higher borrowing costs to close their positions.
At one stage, to borrow overnight was costing 200% on an annualized basis. So a lot of people were very stressed. If you look at the London Bullion Market Association website, that will show X thousand tons in vaults, but a lot of that is allocated for ETFs. So it's not necessarily a free float.
We've seen two very different sides of the coin today. A rock-solid fundamental supply deficit that isn't going away anytime soon, contrasted with a technical warning that the recent vertical move might be overextended. Whether you believe the industrial squeeze will propel us to triple digits, or we are due for a healthy $50 retest, one thing is certain: silver has finally stepped out of gold's shadow. What is your strategy for the first half of 2026? Are you holding through the volatility or waiting for the dip? Let us know in the comments.